Hello, myself Professor Swati Modi. Today we will be discussing techniques of capital budgeting. Capital budgeting decisions needs to be evaluated carefully as it involves large amount of investment and they are irreversible. The techniques of evaluation helps in selecting the most profitable project. There are various methods of appraising the investment proposals which can be classified into two broad categories, traditional and time adjusted. Traditional techniques, also known as non-discounting techniques, and can further be classified into payback and accounting rate of return. Whereas the time adjusted and discounting techniques can be subdivided into three, such as net present value technique, internal rate of return and profitability index. Now let's discuss each technique in detail. First, accounting rate of return. It is the rate of return which is earned on a project on the basis of accounting principles. Some know this technique as return on investment. Its calculation can be done in two ways. In order to calculate the accounting rate of return, the return on original investment should be taken, and in this case the formula would be accounting rate of return is equal to average annual EAT or PAT to be divided by original investment into 100. The accounting rate of return is also known as average rate of return. It is defined as ARR is equal to average annual profits after taxes to be divided by average investment over the life of the project. The average profits after taxes are determined by adding up the after-tax profits expected for each year of project's life and dividing the result by the number of years. In the case of annuity, the average after-tax profits is equal to any years of profits. The denominator can be calculated in the following manner. For original investment, it is equal to original investment plus additional net working capital plus installation charges plus transportation charges if any. For average investment, it is equal to original investment minus scrap value to be divided by 2 plus additional net working capital plus scrap value. Now, let's understand this technique with a numerical example. The table represents the book value of investments for 5 years and profit after tax for 5 years. Using the formula for average rate of return, the accounting rate of return is 1,20,000 plus 1,22,000 plus 1,24,000 plus 1,26,000 plus 1,28,000 to be divided by 5, same with investment to be added, then divided by 5, and finally it is to be multiplied by 100, so it would result into 72.9%. The decision criteria for this technique: the higher the accounting rate of return, the better the project. If the ARR is more than the cutoff rate, the project is accepted, and if lower than the cutoff rate, project is rejected. Let's consider another example. If the initial investment of the XYZ Limited in buying a machine is of rupees 1,21,000, salvage value 11,000, working capital 12,000 and life of the machine is 5 years, and if straight line method of depreciation is adopted, then calculate the average investment. By using the formula, average investment is equal to original investment minus scrap value to be divided by 2 plus additional net working capital plus scrap value will result into the following calculations, and it would result into 78,000 rupees. Let's understand this technique with one more illustration. If two machine details are given, which one would you choose on the basis of accounting rate of return? The table shows the details of A machine and B machine where capital outlay is same for both the machines, that is 1,56,125. For number of 5 years, profit after tax for both the machines are given. Estimated life for both the machine is 5 years. Estimated salvage value for both the machines are 13,000 each. Depreciation has been charged on straight line basis. Now let's work out the solution using the formula. Average required rate of return is equal to average income upon average investment to be multiplied by 100. First step is to calculate average income by dividing 86,875 by 5 for the first machine and second machine both. We will get 17,375. Then using the formula for the average investment, we will calculate the average investment for both the machines. 13,000 plus half the difference between 1,56,125 and 13,000, which will result into 17,375 divided by 84,562.5, which leads to 20.54%. From the numerical example, any machine can be chosen as both the machines gives the similar results. But the fact is, in case of the B machine, the return are higher in the earlier years, which is ignored by this technique. So, the limitations of this technique are: the method is based on accounting profits instead of actual cash flows after taxes in evaluating the project. It ignores the time value of money. The technique is incompatible with the objective of wealth maximization to the equity shareholders. Now let's see payback technique. It is a technique by which the company is in a position to know that in how much time the initial investment would be recovered. It answers the question, how many years will it take for the cash inflows to recover the original cost of an investment without considering the salvage value. There are two ways of calculating the payback period. If the nature of cash flows are annuity, that is when the cash flows are uniform, then in such a situation, payback period can be calculated by using the formula investment to be divided by constant annual cash flow. For example, an investment of rupees 1,60,000 in a machine is expected to produce cash flow after tax of rupees 20,000 for 10 years, then calculate the payback period. In this case, the machine cost or the investment of 1,60,000 to be divided by 20,000 will result into 8 years. If the cash flows are not uniform and vary from year to year, then payback is calculated by the process of cumulative cash flows till the time of cumulative cash flows becoming equal to the original investment outlay. Calculate the payback period from the following details, which is given in a tabular form. For 5 years, annual cash flow after taxes for A and B machine is given, for which the cumulative cash flow after tax has been calculated. If the initial investment in A machine is rupees 75,000, then machine A's investment will be recovered in 2.35 years. The sum of rupees 74,000 can be recovered in 2 years and the balance of 1,000 rupees will be recovered in the third year. The cash flow after tax is rupees 28,000, so the payback fraction is therefore 1,000 to be divided by 28,000, resulting into 0.35. Therefore, the payback period is 2.35 years. For machine B, the payback period would be calculated in the same way. In the first year, 32,000 would be recovered and in the second year, 30,000 would be recovered. So, a fraction of 13,000 to be divided by 28,000 will result into 0.464, which would be recovered in the third year. Therefore, the payback period is 2.464 years. The payback for machine A is lower than the second machine, that is B. Let's understand this technique with one more example. Rishabh Limited is considering two projects. Each project requires an investment of rupees 1 lakh. The firm's cost of capital is 10%. The net cash inflows from investments in two projects X and Y from the table given. It is given in the tabular form for X machine and for Y machine for 5 years. The company has fixed 3 years PBP as the cutoff point. State which project should be accepted. Let's see the calculation of PBP. In case of project X and project Y, first cumulative cash flow after taxes have been calculated for the 5 years. In the first 2 years, 90,000 rupees would be recovered, but still 10,000 is to be recovered, which can be done in the third year. So, 10,000 divided by 30,000 will give you 0.33. Therefore, the payback period is 2.33 years. PBP of project Y is 4 years, so project X should be accepted. Let's understand the accept-reject criteria. The payback period can be used as decision criteria to accept or reject investment proposals. A machine should be accepted as its payback is smaller period. Payback period is simple to calculate and simple to understand. The problem with payback is that it completely ignores all cash inflows after the payback period. This can be misleading in such decisions. It also ignores time value of money and ignores the entire life of the project. As a result, projects with large cash inflows in the latter part of their lives may be rejected in favor of less profitable projects. To summarize, the traditional methods suffers from two serious drawbacks. They do not consider the total benefits and the timing of cash flows. Now we will discuss time-adjusted discounted cash flow techniques. The most important feature of the techniques is that they take into consideration the time value of money and they take into consideration all benefits and costs occurring during the entire life of project. Let's discuss NPV, that is net present value. It is the most important discounting technique in appraising the capital budgeting decisions. It calculates the investment decisions that involves cash flow occurring over multiple periods. The NPV of a project is the sum of the present values of all the cash flows, positive and negative, that is expected to occur over the life of the project. It is the process of calculating present values of cash inflows using cost of capital as an appropriate rate of discount and subtracts present value of cash outflows from the present value of cash inflow and find the net present value, positive or negative. In simple words, NPV is the summation of the present values of the net cash inflows in each year. The formula for NPV can be written as: the formula explains that cash flows reoccurring in all the years should be added with salvage value and working capital released at the end of the life of the project. From this summation, initial outflow should be deducted to get the absolute NPV. A project would be accepted if NPV is positive and rejected if it is negative. Zero NPV would mean that the firm is indifferent to accept or reject the project, as it would leave the company's financial position unchanged. The NPV of a package of projects is simply the sum of the NPVs of individual projects. As a decision criteria, NPV can also be used to make a choice between mutually exclusive projects. The various projects would be ranked on the basis of NPV. The project with highest NPV would be given the first rank, followed by others in the descending order. NPV is the technique which recognizes the time value of money. It takes into consideration the total benefits arising over the lifetime of the project. This measure is an absolute measure, so if two projects with similar outlays have different NPVs, it is possible to make a right choice. But if the projects have different outlays, then NPV may not give the right decision. This method can also not be relied on if two projects having different effective lives. This technique can be explained with the help of an example. Suppose a project PQR costs rupees 25,000 now and is expected to generate cash inflows of rupees 9,000, 8,000, 7,000, 6,000 and rupees 5,000 in years 1 to 5. The opportunity cost of the capital is 10%. Calculate the net present value for the project. Seeing the table, we would calculate the present values of cash inflows. The respective cash inflow would be multiplied by its table value for present value tables, which would result into a summation of 27,250 rupees, from which the outflow of rupees 25,000 will be deducted, which will result into a positive NPV of 2,250. The project PQR generates positive NPV and hence creates wealth for the shareholders and hence should be accepted. Let's understand this important technique with one more example. A new machine costs rupees 2 lakh, requires no increased investment in working capital and is expected to yield rupees 60,000 profit per year for 10 consecutive years. At that time, its scrap value will be negligible. Assume SLM depreciation and a 30% tax rate. If management requires at least a 10% return on any new investment, would the investment qualify? Let's work out the solution. After getting the cash flow after taxes, in which earnings before depreciation and taxes is given to be 60,000, we will have to deduct depreciation 20,000. We will get earning before taxation, that is 40,000. Then we will deduct taxes at the rate of 30%, which will give you earning after taxes, which is equivalent to 28,000. We will add back depreciation of 20,000. We will get cash flow after taxes, that is 48,000. For the years 1 to 10, the cash flow remains the same. In the 10th year also, there is no release of working capital and scrap value. So, taking value from the table A4, the 10th year at discount factor 10%, the value obtained is 6.145, which is to be multiplied by 48,000, and the present value of cash inflows would be rupees 2,94,960. From this, cash outflow is deducted and the NPV is derived of rupees 94,960 rupees. Now let's discuss the other technique of IRR, that is internal rate of return. It is a technique of discounted cash flow for appraising capital investment decisions. The other name for this technique is yield on investment, marginal efficiency of capital, marginal productivity of capital, rate of return, time adjusted rate of return, and so on. IRR method also considers time value of money by discounting the cash streams. It is the rate of return that a project earns. It is defined as the discount rate which equates the aggregate present value of the net cash inflows with the aggregate present value of cash outflows of a project. It can also be defined as that rate which gives the project NPV equal to 0. According to Joel Dean, 1951, IRR takes into account the magnitude and timing of cash flows. If IRR exceeds the discount rate, the project would be accepted, and if the IRR does not exceed the discount rate, it would be rejected. If IRR is equal to the discount rate, the firm is indifferent as to whether to accept or reject the project. If the project IRR is greater than the cost of capital, the project should be accepted. If the IRR is less than the cost of capital, the project should be rejected. If IRR is equal to the cost of capital, the project may be accepted. To understand this technique, let's see a numerical example. A project needs an investment of rupees 13,85,000. The cost of capital is 12%. The net cash inflows are given in the table for 5 years. Let's calculate IRR. Before finding the solution, it is important to know that computation of IRR is based on the cash flow after taxes. In this method, the evaluator selects any discount rate by calculating fake payback period to compute present value of cash inflows, otherwise the cost of capital taken as first trial. If calculated present value of the cash inflows is higher than the present value cash outflows, then the evaluator has to try a higher rate and vice versa. This process will be repeated till the present value of cash inflows equals to the present value of cash outflows. Generally, IRR may lies between two discounting factors. In that case, analyst has to interpolate using this formula. IRR is equal to LDF% plus PVLDF minus COF to be divided by PVLDF minus PVHDF to be multiplied by the difference in the two rates. Fake PBP will be equal to initial investment to be divided by average annual cash flow. So, using this formula, it can be calculated equal to 3.847. Referring to the PV of an annuity of 1 rupee table, we find that the fake payback period of 3.847 lies in between 10% and 8%. So, from the table, we can see the present values calculation at different rates 10% and 8% for 5 years. So, using the formula, we can calculate IRR and it comes to 9.94%. Here, project cannot be selected as the IRR is less than the cost of capital given as 12%. Now, let's understand the third technique, that is Profitability Index, which is also the time adjusted capital budgeting technique. The Profitability Index approach measures the present value of returns per rupee invested. It is the ratio of the present value of cash inflows at the required rate of return to the initial cash outflow of the investment. It can be represented as present value of cash inflows to be divided by initial cash outflow. It is a relative measure, but NPV is the absolute measure. Profitability index is measured by dividing present value of cash inflows by present value of outflows. It is used for capital rationing because NPV does not give the right insight if projects require different initial outlays. This method is also known as the benefit cost ratio because the numerator measures the benefits and the denominator measures the cost. The accept-reject criteria for this technique. A project will qualify for acceptance if the profitability index exceeds 1. When profitability is equal to 1, the firm is indifferent to the project. Suppose the initial cash outflow of a project is rupees 10 lakhs and it can generate cash inflow of rupees 4 lakh, 3 lakh, 5 lakh and rupees 2 lakh in years 1 to 4. If the discount rate is 10%, then what would be the profitability index? present value of cash flows needs to be calculated first, and here it is equal to 11,23,500, which needs to be divided by the outflow, that is 10 lakhs, which will result into 1.12 profitability index. The project with PI greater than 1 will be accepted, and hence we will accept the project. Now let's summarize at the end. The capital budgeting proposals needs a careful analysis which can be done through the various discounted and non-discounted techniques. These techniques have their own advantages and disadvantages. The discounted techniques are superior to non-discounted techniques as they take into consideration the time value of money and the benefits occurring in the total life of the project. Thank you.